All right, good evening. This is Ken Long from Tortoise Capital with a review of the weekend trading report for June 6, 2015. Coming to you live from Kansas City International Airport, Hyatt Regency, Hyatt Place Suites. Great workshop already, 2 days into it. You will not believe some of the briefings that were provided and the quality of the research. It blew me away. I think you're going to want to have the distance study course. It will add value to everything you do. I promise. Details to follow. All right, so let's get started. The market classification, we remain in bullish, quiet conditions. That's going to be good for any follow through to the long side. On an annual basis, using weekly RSI 14, we're at the higher end of neutral with a score of 58 out of 100. Looking at the 10-day market condition using 10-day NDX, we are well oversold at minus 12. So we can expect to see a lot of channeling and overreaction signals. And I would be looking to emphasize the buy on dip opportunities for the strongest of indexes and large caps. So we'll be on the lookout for that. Looking at the market mosaic, the long-term price relative to the 200-day moving average, we are within 3.18% now of the 200-day moving average. That makes us red bullish, meaning that we are still more than 2% above the 200, so we're bullish. But the red color indicates that this is among the worst locations in the last 6 months with respect to the 200. So we have a bull that is still finding difficulty finding a second win. So this is an aging bull that is staggering, and that will cause us to make sure that our swing trades on the long side have very carefully placed stops that are honored, and we would be prepared to be short on any of the weak indexes. Should the market roll over and start cracking, that means Brazil and Latin America would be high on our list for target candidates if we see weakness in the market, defined as failure below Friday's low. Slope of the 50-day moving average has weakened to yellow neutral, so that's another sign of impending weakness. ADX at 14.9 is a very weak trend, and the bears are in charge. That's not good for the long side. ATR percentage, however, is extremely quiet at 0.71%. The risk index is the 30-period moving average of the VIX divided by the 10-period. The threshold between risk on and risk off is 1.0. The current reading is 0.992. So we have just tipped into risk off conditions, meaning that less risky assets are favored. When we take the score of 0.992 and compare it to the last 5,000 trading days and compute the average and standard deviation, that gives us the risk Z. That reading is at minus 0.17, so we are 0.17 standard deviations below the 5,000 trading day average. And you can see the 90-day histogram of that indicator here. And you've seen we've had 3 higher lows, and we have dipped back into the red. And it will not take much for volatility to explode here. Because we are already in bull quiet conditions. There was not follow through this last week, showing signs of cracking in some of the market leaders, and we've dipped into risk off. And so this could be a threshold for a sharp break to the downside. We're so close to the 200 that that's going to be a real concern to people who are placing their stops just below the 200-day moving average. So it would not surprise me at all to see a test this week of about a 3% pullback. That will trigger a lot of selling pressure. That would cause a spike in volatility. VXX will be a very good day trade at that point, and we may see a rebound in treasuries or the defensive plays in the U.S. large caps like healthcare and consumer staples. Looking at the blended monthly rebalancing, the next reevaluation is due on or about 1 July. You can see the current holdings, and in the box, the sector leaders based on the close on Friday of 6 June. You can see XLV and ETF 22 and 32. That's that consumer, or that's the healthcare sector spider, and meanwhile Japan continues to look strong. And inside the U.S., you'll notice in ETF 13 that it's small caps and mid caps instead of last year's leaders, the large caps. In ETF 2, the theoretical exposure in the asset allocation model is 70% to global equities. The model portfolio itself will be at 100% exposed because we have stops in place and they haven't been hit. The Kansas City workshop has been extraordinary. The drumming was remarkable. We'll have some audio of that up to upload later. Moving on. This is one of the detailed charts that I look at that I wanted to just highlight for you. This is based on the relative strength of the 11 major indexes and compared to SPY. And I say normalized for statistics. What I mean by that is that we've converted their 30-period regression line slope, which is a proxy for health, and subtracted out the health of the S&P. And so this is the residual alpha, or the residual strength of each of these indexes after we've discounted SPY. So things that are looking really strong in my view according to this would be IWM and MDY. And the reason I say that, let me get the pen working here. IWM, you notice, come on. IWM here has gone from negative territory and has been steadily marching northward, and you can see that's why it's at the top of the BMR stack, and you'll see it's one of the strongest two indexes in the world market. MDY has also got that same kind of action going on. Meanwhile, you can see the weakness in Latin America is continuing. The diamonds reflect the weakening large caps in the U.S. as well. EWJ is slowly coming out of the sea. It's got other structural problems, but it still has an upward trend. Technology might be ready to follow through. It's lagging behind mids and smalls, however. The European and globals, EFA, showing signs of continuing weakness, troubles in Greece. Oil, after a nice little rebound here, is started to roll back and lagging. Gold, looking weak. And blended commodities, horrible. And actually emerging markets are not the worst thing out there. Once you discount Brazil, the rest of the emerging markets maybe not too bad. But the two real standouts for me right now in terms of gathering strength are U.S. mid caps and U.S. small caps. And so I will be prepared to reinforce those intraday and in starting swing trades in IWM and MDY should we see those kinds of signals this week. Just a quick look at the blended monthly rebalancing portfolio leaders, ETF 13. Excuse me. You'll notice that more are on cash signals than are on buy, and the buy signals feature Japan, U.S. small caps, mid caps, tech, U.S. large caps, and then EFA. But it's diamonds and everything else are lagging, and especially that weakness in Latin America is troublesome. In the ETF 32, again, only about 1/3 of them are on buy signals. The sector spiders to take note of are healthcare, consumer discretionary, those are the defensive plays. Financials may give us some tactical movement here, XLF, and then technology, XLK. At the bottom of that stack, Brazil and Latin America, again, the worst of the ETF 32. And the weakness in commodities, DBA and DBC, are affecting Australian index as well, if EFA, or EWA, excuse me. Treasuries and U.S. real estate both suffering too. And so the scenario that I'm looking at for those to be effective are that if we get the U.S. Large caps continue to roll over, followed by Europe, and then maybe some of the steam coming out of the Chinese economy. Then there's some value plays built in there in treasuries and U.S. real estate as an alternative to equities, and so we might be able to buy those on deep discount. Moving on. Now we're looking at ETF Max, and that's the top 50 or so of the ETFs from the expanded world market model. The ones I want to highlight that are of interest: China Materials is kind of interesting in position number 8. It's had an extraordinary 3-month and 6-month move, but it was red, so big loser over the last 1 week and 1 month. So that's either a signal of a deep discount buy on sale, or it's pointing to the possibility that the Chinese mini bull here is over. China Alpha Dex in 13th position is in the same category as is the MCHI Broad China Index and the China 25 in 19th and 20th position. Alpha Shares China Real Estate also showing that 1 month and 1 week pullback. And so to me, there's some evidence mounting that the Chinese move is over. So be prepared for that by having your stops in place. Things that are doing well, though, the China small cap and the market vectors China both had extraordinary weeks. So China's giving mixed messages. It's a trader's market there. Just respect your stops if you're working in that area. Now, what's kind of neat here is a couple alternative asset classes. Position 31 and 32 and 26 are all greens across the board. 1 week, 1 month, 3 months, and 6 months. That's going to be S&P small cap healthcare. Hard to go wrong with that one because you got small caps and you have healthcare in the U.S. That's not bad at all. And then KBW Bank ETF is symbol KBE is strong, is in the green on 1 week, 1 month, and 3 months, but not yet on 6 months. So that suggests that we're early in the opportunity phase. Next up is a quick look at the top 40 or top 50 in the S&P 500 through the BMR lens. Some symbols to examine here. Humana, we talked about that one last week, turned in quite an extraordinary week at plus 20%, 27% for 1 month, and is greens across the board. Regeneron is a biotech in the healthcare area. That's all greens. Cigna Corporation, all greens. GameStop, all greens. So we'd be looking for additional follow-through. Zion's Bancorp is kind of interesting here. It's greens on 1 week, 1 month, 3 months, but not yet on 6 months. So there could be some that we may be early in its market cycle as well. Might consider Cablevision as a buy value on dip opportunity. It's greens across the board except for 1 week where it had a significant pullback. So that may create a fire sale for Cablevision. Okay, moving on. Next up, market health check. Right, so the vertical lines, vertical blue lines here are 10 days, 20 days, and 30 days worth of look back. And then the big thick blue lines are 30 days and 60 days. Horizontal purple line at 214 is the recent swing high, all-time high in the S&P. We need to see a close above that price to really be convinced that this pullback is over and that the bull is marching on. So it's got quite a bit left to do there. The blue line is about where I would place fair value in the middle of the 10-day period. It's right at the Bollinger Band mean in the middle of the river. The dark blue shaded area is the river. That's the 30-period Bollinger Band, plus or minus 1. Lighter blue shaded region is the floodplain, slightly lighter blue shaded at plus or minus 2. The outer red lines are the Bollinger Bands, plus or minus 3. The blue channel in the middle of the river here is the 10-period regression line, and the outer two blue lines are the regression channel formed by the maximum excursion during the look-back period, which happened about 9 days ago. So the slope of that 10-period regression line is down. Price is in the lower half of that channel. That's a sign of weakness. It also happens to be resting on the south shore of the river, and so the market is in a critical state right now. It's oversold on Williams percent R10, so that's where all the channeling signals are going to be coming from. It's resting on key support at the edge of the river. If that fails, we could expect a test of the floodplain at 208.5. If that fails, a testing of the Z-3 here at 207, and then it's a short march down to the 200 period moving average at 203.5. And then we would be basically in sideways market conditions were we to violate the Z-3. So that's how much is left of this bull market. The black line in the three channel lines there in black, that's the 30-period regression line lagged by a day. The slope of the 30 is still up. The channel, however, is wide because of the magnitude of this recent pullback. And so this is really just the first leg of the market has pulled back. On the right-hand side, you can see the blue shaded area. That's a new add to the chart. What I'm showing there is a 5% pullback from the swing high. And so prices within 0 and 5% of the all-time high or the swing high would be classified as market noise by the media and large market players. We've retraced almost half of that right now, so we're down 2.5% from the swing high. So still within the noise range, although it is triggering some tactical swing trade patterns here. I want you to notice the slope of the river is still up, so that's favorable for the bull. Oversold conditions. Now the jaws of percent price oscillator, PPO, are open to the downside. That's a sign of weakness. That's triggered by this approximately 10-day pullback. You can see that ADX is rising. It was as low as 10 and is right around that critical 15 point right now. Bad news for the long side is that the bears are in charge. What this means with ADX that low is that there's a possibility for a good 2 to 3 week swing to start from this location. That would not be unusual at all. That could be another 10% move in either direction. If that were to the downside, we would be well below the 200, and that would change some people's minds. I'm concerned that the dragon has rolled over. After being out of the river, the dragon has rolled over and is now back to just at the Bollinger Band mean. The last time that it did that was back here in March, and that was a move from about 211.5 down to 204, so that's a $7 move. Were that to happen here, we would see a move from 213 down to 206, which would take the market out of the Z-3, and so that is well within reach. The thing to notice is that back in March, it took 2.5 days to traverse that distance, so that correction to the downside could be sharp indeed, and I will be prepared to go short as soon as it violates below Friday, because we're in the yellow zone and we're almost getting ready to get into this red zone, in which case I have a short side bias. So it wouldn't take much for me to start playing tactically to the downside. If were that to happen, I'm going to look for weak indexes like Brazil or Latin America, or play the usual suspects with TZA or FAZ in the financials. So we have a market, in my view, that's at a critical state. It has pulled back once more. There was a very weak follow-through in the past 20 days. It's getting dangerously close to sideways channel. The slope of the 30 is weakening. It's still above the 0 line, but it's definitely weakening, and it's hard to see where the leadership's going to come from. So that's making me depressed. So that means I better be ready for the short side. Next up, the ETF2 regional report. You can see that 3 of the indexes are on cash signals. 7 are on buy signals. That's price with respect to the 4-month moving average. So that keeps us at 70% invested, 30% cash in the asset allocation strategy. Right now we're still in bull quiet. EFA with a strength score of 41 is still stronger than the U.S. large caps with a score of 39. So for a while yet, the globals are still favored over the U.S., although that gap is starting to close. Inside the U.S., the strength is in the small caps at 43, the mid caps at 42, tech at 40, followed by the large caps at 39. The two strongest sectors in the world right now, Japan and the U.S. small caps. The two weakest sectors, Latin America at 34 and Asia less Japan at 36. Inside the sector spiders, what we have are the only sign of strength are in discretionary, XLY, healthcare at XLV, and a little bit of technology here at 39. Everything else is in the yellow, and which is below the large ETF database average. So weakness has definitely infected the U.S. large caps. Last year they were the runaway leaders. This year not so much. Next up, world market model. Everything in the U.S. is above average with the exception of the diamonds, the DIA, which is in the yellow at 38. The only signs of strength right now are the private hedge fund equity ETF. China still has some strength at 63, Hong Kong at 50, but the rest of Asia all below average or well below average. Good performances in Europe, but starting to see weakness in Germany and Spain. All of the commodities have actually improved to being just below average. Last week, half of those were in the red, so maybe we're seeing some value creep into the commodities. ETF2 database gives us the same insights as the BMR and nothing different to report there. Inside the Dow 30, looking at them through the ETF2 lens, we notice that there's some new weakness has emerged in travelers, which is red on the strength and yellow on consistency, and DuPont has become weak here at red on strength and yellow on consistency. ExxonMobil, on the other hand, is yellow and red. That's a potential for moving up, as it's been horrible and now it's not quite so horrible. Caterpillar is a little bit later in its business cycle phase. It's in the white on strength, yellow on consistency, so that's improving. Merck is improving with yellow on consistency, white on strength. Weakness coming into Apple, white on strength, green on consistency. At the top of the stack, Goldman Sachs, green on strength, white on consistency. That would therefore become one of my high priorities for follow-through. If the market is up and financials are doing better, I'd look to see if Goldman Sachs was best of all, and if so, would immediately reward it. On the other hand, Walmart with red and red, if the market were weak and Walmart were weaker, I'd be looking to be short. Shifting now to the daily report. There we go. So a number of overreaction signals in the Dow 30, the globals, EFA, and European large caps, IEV. Channeling signals in the U.S. large caps with SPY, in the globals, EFA again, and then European 350 again, IEV. You'll notice that the market with ADX is still very quiet. Notice the rising ADX, meaning increasing strength of trend for the bears. A ton of channeling and overreaction signals to consider in both the large caps and the ETFs. Looking at the 10-day max pain, the biggest percent losers the past over the past 10 days. Intel, Verizon, Johnson & Johnson, Boeing, Travelers. Looking next at the Dow Tactical. Plenty of signals to choose from the pattern trades. Lots of channeling and overreaction to choose from. All of them test out better than 2-to-1 on the Autoframer. We have a 5DD in Verizon. We have 4 551Ws in Visa, Nike, United Tech, and GE. Given the broad sell-off on Friday, having a 551W is actually a good pattern because they had up days, and so that could be some relative strength leaders, so would be on the watch out for that. But plenty of frog quality numbers better than 3, so those will be of interest. Particularly if we get some selling pressure early, I would expect to see some frogs to the downside fire. We got many RSI2 signals. That's RSI2 less than 10. And so Cisco is especially interesting. It's an overreaction. It's channeling. It was a doji on Friday. It tests out at 3.4-to-1 on the Autoframer. It's the second best max pain range compression candidate. Frog quality number of 3 and the RSI value, RSI2 value of 2. Hard to argue with any of that stuff. All very interesting. So target-rich environment. If you're looking for continued weakness on Monday for the ones that were the weakest on Friday, you'd be looking at Intel, Walmart, and Coke. Again, they all test out well on the Autoframer. They look good on the Frog, look good on RSI2. Intel has the added advantage of being max pain range compression. So lots to choose from. What I want you to notice in the NDX columns, the 3 NDX columns, all those signals firing red are all things that closed lower than their previous low during the look-back period. So the first column is the 10-day look-back. Everything in red closed well below the previous 10-day low. And the same thing with 1 month and with 3 months. So we've got some weakness creeping in. Financial sector is interesting here, though. JP Morgan and Goldman Sachs both closed well above their 10-day, 1 month, and 3 month trading ranges. So that tells me there may be some residual strength in the financials. That means on our short list, we've got to have the triple leverage financials, FAS for the long side, FAZ for the short side, and we'd be watching symbol XLF as our trigger for market health, or for the financial market health. Shifting now to the Autoframer. It's going to show us all those that tested out well with the structured trades for mechanical entries and exits for swing trading 1 day at a time. Plenty to choose from there. Emerging markets at 5.8-to-1, McDonald's and Verizon and Asia less Japan all better than 5-to-1 on the risk to reward, or reward to risk, excuse me. Looking at the regression line fractal framework, Procter & Gamble is the symbol in the Dow 30 that is the most number of ATRs below its own 270 regression line, with 10 ATRs below, as is Travelers at 10-to-1. The symbols in the red in the second stack are the ones that are the most number of ATRs above their own 270 regression line. So IBM is 6.5 ATRs above its 270 regression line. General Electric, Caterpillar, all looking pretty strong there as well. With BXX, almost 9 ATR below its 270 regression line. That's a function of the bullish quiet market that we're in, and things will stay quiet until they can't stay that quiet anymore, and then we see sharp VIX spikes, and so we're well positioned for that downside test. We're only 3% away from the 200-day moving average. If we saw a spike down to test that, that would drive the VIX through the roof, and that would be a terrific intraday trade. So we'll be prepared for that tomorrow. I'm experimenting with Excel to have it auto-generate the Dow 30 RLFF value plays. That's these top 5. These are the ones that are the most number underneath their 270 regression line. You can see all of the symbols are down on their regression line and had a bad day Friday. So I'd be looking to pile on these to the south if we had market movement downward. So Procter & Gamble, Travelers especially, was a big sell-off. You can see that spike on Friday. Walmart was weak. I'm ready to go short that instantly. Alcoa is showing weakness. 3M is the interesting play here because its 30-period regression line is actually up. This may be, we've already seen one effort to improve, and we may have a value play here with this anomaly of that big gap and a doji on Friday. So 3M, if we see market strength tomorrow, 3M maybe go north to try to close that gap. That could be an interesting one-day play. The bottom stack are the ones that are the most numbers of ATRs above their 270 regression line. The one that looks really nice to me, JP Morgan. It was a big winner on Friday. Closed at a 30-day high with the doji. So I'm ready to go in either direction on JP Morgan. AT&T looks like it rejected that nice move Thursday with the big down move on Friday. Caterpillar is just waiting to crack and roll over. General Electric has found some support here at 27.30. If we get market strength, that's not a bad play to the upside. IBM doesn't look favorable, even though the slope is slightly up. Friday's price action harmed in terms of trade location. So this chart and that are the regression line 30 slope stat are a couple experimentals. If let's watch them this week and see if they add value to our process. If so, we can make it a formal part of the daily. Looking at the market mosaic right now, again, we can see the 30-period regression line here, and then the sharp move against it on Friday, a gap down that couldn't close its own gap. That's caused the adaptive regression line to roll over. We can see that the slope of the 30 is right at the 6-month average, and it's had a series of declining highs and rising lows in terms of slope, and that puts the market in a really critical state right now. It's been hovering near, for 60 days, it's been hovering near the that swing high, was never able to get follow through. Meanwhile, the 200-day moving average has marched northward, and we're close to drifting into sideways and then bull market. This is such a quiet market. It's just waiting for leadership to emerge or for fear to start cracking. You notice how tight the range has been in the last 60 days with respect to the 200. So this is a market that's coming to a decision point. I will not be surprised if there's a 3 to 5% test to the downside, just to shake out the weak hands. And that's everything I wanted to cover from the daily report. Lots of things to look at for trade framing purposes. We're going to do another trade framing session here at the workshop, and so I will call it here and get this posted and uploaded. There's a ton of good things to look at in the auto framers, and there's good candidates to pounce on whichever way the market starts to break on Monday, which I would expect since it's in short-term oversold conditions. I think the financials are very interesting. I think the U.S. small caps are making a stealth move up, and I would expect that to be the source of leadership if we get strength in the U.S. market. So look for follow through in TNA. The VIX pair, VXX and then XIV, are going to be working this week, I think. But again, we're in the early stages of a potential swing. So keep your powder dry and your risk measured, and we'll see you in the chat room. We'll hope to get a bunch of charts posted tonight with specific trade frames from the folks here in the workshop, and so you can look for them to supplement your plan. So that's everything we got here in Kansas City. We're still digesting that championship barbecue and the awesome presentations from the folks all weekend. It's some extraordinary work. Can't wait to share it with you. So take good care, and we'll see you in the chat room.